It's federal budget week, and the big unknown is whether federal Treasurer Jim Chalmers can keep a lid on inflation. The biggest radio deal in years is close to falling over after one party pulls out, and directors of some of the biggest tech companies are selling their shares. Welcome to Fear and Greed Daily Business News for people who make their own decisions. It is Monday, the 13th of May, 2024. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, after the show, you have an interview coming up today with Josh Gilbert from eToro. We love talking to Josh.
We do love talking to Josh. Today, we talk to him about, we start off with US tech stocks, but then we look at another sector which is doing particularly well on Wall Street. It's the cruise line sector. So we run through how some of the Royal Caribbean and Carnival are going, as well as all the normals, Apple, Microsoft. Very insightful, Josh. Always, puts it in plain language. You sort of understand where he's coming from, what you should be looking out for as an investor. Great chat with Josh.
Yeah, it certainly is. It is well worth a listen coming up after the show. The main story, though, this morning, Sean, you can feel the excitement in the air, can't you? Because it's federal budget week. Am I overstating things a little bit?
Not for all those economists and politicians and business leaders out there, because so much of the business world depends on both how much the government spends and how they spend it, particularly if there's policies directly affecting businesses. Also on economic parameters, what's happening to inflation, employment, all those sorts of things. Also policy changes. So plenty for people to be excited about this week, Michael.
So basically I can just cut loose.
Yeah,
with the excitement. Don't need to hold back because I am excited. Tomorrow night, Treasurer Jim Chalmers will outline the government's spending and taxing plans with the biggest focus really on cost of living help, followed by what the budget is going to mean for inflation, as you just said.
Thus far, the government has announced a bunch of spending initiatives and not very much in terms of savings. Ernst & Young Chief Economist Sherelle Murphy has provided a very useful list of what we know already. Major policy announcements included $11.3 billion for funding for housing, $11.1 billion over 10 years for a Navy fleet, a multi-pronged Future Made in Australia package. Remember the quantum computing group, Quantum, they got money for that. Solar Sunshot program, that's another one. There's health research, people getting money for that. There's also more money for aged and child carers, including superannuation for parental leave, money for drought relief, for anti-money laundering and skills training. Of course, there's also around $23 billion of stage 3 tax cuts. We'll all start feeling that from July 1. There should be good news on the revenue side. Migration, lower unemployment than forecast, meaning fewer payments to the jobless, and higher commodity prices will boost incomings. The Treasurer has said that some deficits going forward will be larger than previously forecast and some smaller. Now, I think I'd be surprised if the government didn't have a budget surplus for the next financial year. The latest projections from MyEFO, which is the mid-year budget update, that was late last year, that was for a deficit next financial year of nearly $19 billion. I think they will have brought that to a surplus somehow.
Sean, that list that you went through it's quite a long list, really, isn't it? And this is just what we know in advance in terms of the initiatives that we can expect in the budget tomorrow night. As you say, there's not a lot in terms of savings there. Are all of these measures likely to be inflationary? And I suppose then the natural follow-on question for that is what's it mean for interest rates?
Well, that is the most interesting question, or certainly the most interesting economic question coming out of tomorrow night, and we'll know pretty quickly after 7:30 p.m. Dr. Chalmers has said the budget will be inflation fighting first and a growth budget in later years. The challenge is if the government provides big handouts over the next 12 months, then you can kiss the prospect of lower interest rates goodbye, at least for this year. The budget is the government's fiscal policy. The Reserve Bank oversees monetary policy. They need to work together. And the budget, i.e. fiscal policy, is much better at making refined changes to the economy. Interest rates are like a big sledgehammer hitting the economy. So you hope that the budget is really well targeted and non-inflationary. I think that at the end of the day, that is kind of the question we'll all be wondering about, because if it is inflationary, it's going to be very, very hard for the Reserve Bank to cut interest rates.
Sean, two quick mentions. Actually three. I'll combine them into two. Though Stephen Koukoulas, our resident economist, well worth a listen to The Week Ahead, which comes out every Monday, because you ask his thoughts on kind of what's coming up in terms of the budget. Then Stephen's going to join us on Wednesday morning as well, and a more comprehensive look at actually what was announced. And also make sure you head to fearandgreed.com.au and sign up for the newsletter, the Fear and Greed newsletter, because that comes out on Wednesday morning. Perfect timing, really, isn't it?
It is really,
It comes out every week on Wednesday morning. And it just so happens that this is after the budget. So maybe we will hear what you really think.
Maybe. Probably, in fact.
I think it's highly likely, really, isn't it? Local markets. How did they finish up on Friday?
S&P ASX 200 closed up almost 0.5% to 7,749 points. For the week, the benchmark finished up 1.6%. The big movers on Friday were the energy stocks, while the gold stocks did pretty well also, rising on the back of gold prices. Energy stocks were up on the back of higher oil prices. Within the energy sector, Woodside finished up around 2%. Santos, Ampol and Viva Energy also did well. Gold Digger Northern Star closed up 1%. All the big banks did pretty well. National Australia Bank, Westpac and ANZ were all up more than 1%. Macquarie Group jumped 1%. The big miners were lower and the retailers were mixed. In the bond market, well worth having a look at the bond market ahead of the budget tomorrow night. Futures trading implies a 22% chance of a rate hike, in August, though the consensus is definitely that the next move will be a cut at the end of this year or early next year.
All right, checking international markets now, thanks to Blue Chip Communication, the experts helping financial services companies market, communicate and grow. Visit bluechipcommunication.com.au. Much happening, Sean?
Well, global share markets finished last week higher, with Wall Street up nearly 2% over the 5 sessions. Eurozone shares were up more than 3%, hitting a new high. Markets are heavily dependent at the moment on every utterance from the Federal Reserve about interest rates, and basically last week the pendulum swung back towards a rate cut later in the year. Outside rates, the situation in Israel, the US election and prospects of a soft landing for some of the world's major economies are affecting markets. One stronger market recently has been China. So, Michael, between 2021 and February this year, the market fell 45%. That was all about the Chinese property market, slowdown in the economy. Since February, though, it's up about 15%. Interesting. In commodity markets, Brent crude was lower again. Gold's fetching around $23.60 an ounce, and the Aussie dollar is buying just over 66 US cents.
Sometimes I just don't have anything intelligent to add, so you'll just get a out of me. Sometimes it's better saying less, really, isn't it?
Well, I liked your
Yeah, it's insightful, wasn't it? All right, we'll be back in a moment with the rest of the day's business news. Sean, a deteriorating regional advertising market, the closure of a TV station in Mildura, and Network 10 pulling the pin on The Bachelor all contributed to Anchorage Capital Partners' decision to pull out of a $250 million deal to reshape the Australian radio market.
7 months after it was announced, Anchorage apparently has withdrawn from a deal with Australian Radio Network Media to acquire ASX-listed Southern Cross Austereo, according to a report in the Financial Review. The ARN's board convened for a crisis meeting over the weekend and will face investors at its annual general meeting tomorrow. ARN, of course, owns the KISS and Pure Gold radio networks, as well as a network of regional radio stations. Southern Cross owns the Triple M and Hit radio brands, almost 100 regional free-to-air signals, and a larger regional network of radio stations. In the deal that was proposed, ARN was going to take KISS and Triple M and 88 regional radio stations. Anchorage Partners was going to end up with Pure Gold, Hit brands, as well as 35 regional stations and Southern Cross's regional TV network, which is where The Bachelor comes into it. Anyway, according to the report in the Financial Review, all fallen over. Anchorage has walked away. Expect to hear something from ARN to the ASX today.
Sean, the number of auctions remain high, though the preliminary clearance rate has fallen to 72.6%, which is the lowest since Easter.
Still pretty solid, though. Sydney's still doing really well, came in at 75.9% over the past week. Melbourne was at 68%. Adelaide was the standout, 91.7%, the second highest of the year. Brisbane was just under 77%, and Canberra came in just over 71%. The finalised clearance rate, as opposed to the preliminary clearance rate, is around 65%. That's about the long-term average. What's interesting is that the number of auctions remains really high, running at 25 to 30% more than a year ago or so. In terms of prices, the overall average continues to creep higher, though that covers big disparities. Perth is really hot still. Melbourne, not so much. In fact, over the past 4 weeks, Melbourne prices are actually slightly lower.
QBE is pushing through double-digit insurance premium increases, but some good news for consumers. The pace of increases appears to have slowed to the lowest in a year.
That is like finding silver lining in a very dark cloud.
Yeah, I sounded very excited saying that. I'm like, really, it's really not that exciting. It's still pretty miserable.
Premiums going up, just not as much as they used to. Anyway, at the group's annual general meeting in Sydney on Friday, QBE, which operates in 27 countries, covering everything from aircraft to organ transplants, said markets have supported premium increases this year. Premium rates in Australia have been rising at about 11%, which is actually down over the previous year. It reflects the higher risk insurers have to take on, and QBE Chair Mike Wilkins called for more government help. The bill for claims from weather disasters for 2024 is actually tracking broadly in line with assumptions, QBE told investors. Now, one of the big unknowns for these insurance companies, exactly what's going to happen with natural disasters and weather and stuff like that. Well, it's kind of in line with what they thought. Net costs from catastrophes were $300 million in the first 6 months of the year. It's budgeted about $609 million, so kind of on track.
Hey, Sean, question without notice. Your favourite. Because you know how, obviously, in terms of AGMs, QBE was on Friday, just gone, and ARN is tomorrow. Plenty of AGMs happening around the place now. In your career as a business journalist, you would have attended plenty of them, and I know that in the past we've talked about kind of which ones had the best food. But if you were to attend an AGM at the moment, is there one that you would love to go to just because of the drama that's going on within companies at the moment?
Great question. So this one, the ARN tomorrow, should be interesting because there's great personalities involved. Same with Southern Cross Austereo, great personalities involved. So that would definitely be a good one.
Yep.
I have to think hard about that. Not the banks, not so much the miners. Some of the lithium players would be interesting because they've gone backwards. Anytime the share price has done really poorly, that's when you want to go to the AGM because you've got shareholders who've got their money in it and they're not real happy about it. So that's probably how I judge it. The bigger the share price drop, the better the AGM. Rule of thumb.
Great answer. Fantastic answer. Sorry, as if you needed a mark. You needed approval for your question without notice answer. That's good. Nice. Anglo American's key South African shareholders are open to a takeover offer from BHP, with some advocating for an additional cash component to the bid, according to the Financial Times.
The investors, who collectively hold more than 15% of Anglo American, said BHP needs to sweeten its offer, but they're not opposed in principle to an acquisition by the Australian group. The FT is reporting that other fund managers with minority stakes in Anglo are pushing for a more straightforward offer from BHP, possibly with the cash component or without the condition of selling Anglo South African assets. Late last month, Anglo American rebuffed BHP's $57 billion scrip takeover proposal, saying it significantly undervalued the London-listed miner and its prospects. Now, management at Anglo have spent months undertaking a review of the business. Anglo's kind of fallen behind some of the other miners, according to some investors. The idea is that management is going to have some sort of turnaround plan. With this BHP offer, management are now under the gun because if they've rebuffed it, they need to come up with a better option. So it's going to be an interesting few weeks in that takeover tussle.
You know which AGM I'd go to?
Which one? I'm sorry, I didn't ask you before. Which one?
Maggie Beer Holdings.
Oh.
Only because the food would just be top notch, wouldn't it?
Yeah.
Like everyone would just be sitting there stuffing their faces with quince paste and no one's kind of paying attention to what's happening on stage.
One of the things that we don't talk enough about is just the negatives of COVID, the non-health negatives of COVID. And one of them was that all these companies realised they could have their AGM online. And so you do find a lot of the smaller companies now having AGMs online.
Okay, well, that's my homework, to check whether Maggie Beer Holdings has an in-person AGM,
and
what the food is like, and whether I can attend.
That's right.
Maybe we could both go, Sean. Last one before we get to international news. New data shows that the average time spent on social media over the past 3 months has declined, and Australians generally spend less time online than people from other countries. I'm actually a bit surprised by this.
So was I. The average daily time spent on social media is 1 hour, 54 minutes, which still seems like a lot to me, to be honest. Almost 2 hours on social media. The global average is 2 hours, 20. Platform preferences vary by age and gender. Younger women prefer Instagram and TikTok. Younger men also like Insta. About 27% of Australians get their news from social media, which is less than the global average of more than a third. The research from social and media intelligence group Meltwater shows more broadly that the average daily internet usage in Australia is a little over 6 hours. It's a fair bit, 25% of your time online. 2 in 5 Aussies decline cookies, which is about the same proportion of people who are worried about the use of personal data. Maybe no surprises there.
Makes sense.
And what do we do on the internet? Stream video, number one. Music streaming's two. We're also big online gamblers.
All right, turning to international news now, and a very serious story, Sean. Israel has ordered more people to flee Rafah as it prepares to expand its assault on the southern Gazan city, despite international condemnation of its offensive in what is a densely populated area.
The Israel Defense Forces said over the weekend that Palestinians should leave 3 districts close to the centre of Rafah and 2 refugee camps in the city. It instructed them to move to what Israel describes as a humanitarian area on the coast. The UN estimates that about 150,000 people have already fled Rafah since Israel sent ground troops to the eastern edge of the city last week and seized the border crossing with Egypt. US President Joe Biden last week paused the delivery of some arms to Israel, including 3,500 bombs, over concerns that they would be used in Rafah.
Now, I mentioned this one at the top of the show, Sean. Insiders at the Magnificent Seven tech companies are following Jeff Bezos and Mark Zuckerberg in selling shares while stock prices are high.
Follow the money. That's always the kind of goal of investing. Follow the money.
Yep.
Almost a dozen executives and directors at the companies have sold shares since late last year, pocketing about 160 million US dollars, 242 million Aussie dollars. They really haven't cut their stakes in a lot of the tech stocks in as long as 9 years, according to data compiled by Bloomberg, but all of a sudden they're selling. So kind of, what's it mean? Take Alphabet Chief Executive Officer Sundar Pichai. He's sold more stock in Google's parent company this year than all of last year, pocketing about 30 million US dollars. Nvidia's director Mark Perry sold more stock so far this year than in the previous 2 years. Apple chair Arthur Levinson filed in February to offload his biggest chunk of Apple stock in more than 2 decades. The moves basically show how Silicon Valley insiders are monetizing their holdings after tech stocks hit new highs. Even directors in Tesla, which hasn't done so well this year, are selling. So Chair Robin Denholm, who's obviously an Australian, sold about 52 million US dollars worth of the EV maker's stock after not having touched her stake since 2022. The biggest overall winner from the Magnificent Seven's recent rally is Amazon founder Bezos. He netted about 8.5 billion US dollars, unloading stock over less than 2 weeks in February. But it is interesting that the directors of these companies all of a sudden are selling.
Now, what about this one, Sean? Apple has apologized for an advertisement showing musical instruments, artistic tools, and games being crushed by a giant hydraulic press that left it facing accusations of cultural insensitivity.
Yes, the 1-minute video was launched by Apple Chief Executive Tim Cook to support its new iPads, the first time the US tech groups overhauled the range of tablets for about 2 years. The campaign, soundtracked by Sonny and Cher's 1971 hit All I Ever Need Is You, is designed to show how much Apple has been able to squeeze into the thinner device. The ad, though, triggered outrage, according to media reports. The FT says that social media users responded to Cook's X post by accusing Apple of crushing beautiful creative tools and the symbols of human creativity and cultural achievements. Apple's Vice President of Marketing and Comms, Tor Myron, said late last week the company had missed the mark with the videos. Certainly didn't miss all those things that it was crushing, but did miss the mark in terms of cultural insensitivity.
Goodness me. All right. Sean, up next is the Fear and Greed Daily interview. You're speaking with Josh Gilbert from eToro, and of course, Apple gets a mention.
It does get a mention. We talk about Apple's share price, whether it's a buy or a sell. Same with the other major tech stocks, but we also talk about the cruise sector. Plenty going on there. Great chat with Josh.
Yeah, and of course, we're not an investing podcast. You should seek professional advice before making investment decisions, but it is always interesting hearing what someone like Josh Gilbert, who is kind of immersed in that kind of swimming around in the cruising sector, isn't he? There you go.
Oh, I like that.
Oh, how about that? Yeah. What he thinks about the whole space. It is up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au, where you can also sign up for our newsletter, which comes out on Wednesday. And don't forget about Fear and Greed the week ahead as well, because it's actually a very big week. It's not just the budget, isn't it?
No, we've got plenty of other things. We've got unemployment figures. We've got wages data. Very important week just for economic statistics, quite apart from the budget.
And one other thing, Sean, nearly forgot to mention this one. We have a special bonus episode today.
Ah, we do, yes.
Of How Do They Afford That, which is our sister podcast, all about making your money work harder for you, featuring me and Canna Campbell, financial planner. It usually comes out on Wednesday. There is a bonus episode out today that is all about stretching the household budget. And it's in partnership with Cash Rewards. And it is about kind of the fact that people, like engaged customers who are doing kind of their shopping using this Cash Rewards platform are earning kind of somewhere upwards of $400 a year.
Wow.
In cash back from this. It's fascinating. And so it's available wherever you listen to podcasts. Just search for How Do They Afford That. I'll also put a link in today's show notes as well. Thank you, Sean.
Thank you, Michael.
It's Monday, the 13th of May, 2024. Make sure you're following the podcast and join us online on LinkedIn, Instagram, X, TikTok, and Facebook. I'm Michael Thompson, and that was Fear and Greed. Have a great day.